Welcome to Talk Tickers. If you are a regular listener to the show, you already know the drill.
Right.
Usually we're here, tearing apart earnings calls. We're looking at forward guidance. We're analyzing EBITDA adjustments. And we're basically trying to figure out if a CEO is actually sweating through their shirt or if they genuinely have a handle on the next quarter.
We live for the quarterly grind.
Exactly. We live for the forward guidance. But today we are doing something completely different.
Yeah, it's a massive departure from our usual programming.
It really is.
Because we aren't looking at a single stock today. We aren't even looking at a single sector's earnings. We're looking at the plumbing.
The engine room.
Exactly, the engine room. It's the engine room of the entire global economy. We're going deep into this fundamental mechanic that drives almost everything else we talk about on this show, but it rarely gets the spotlight itself.
And I'm really excited about this deep dive because I think it's going to explain a lot of the why behind the numbers you usually see on your screens.
Definitely.
I want to start with a visual that I think perfectly captures the problem most investors face. It's a concept that kind of breaks a lot of people's brains when they first hear it.
The iceberg illusion.
The iceberg illusion, exactly.
I love this analogy.
So if you're listening, picture an iceberg. Most investors, and I am including the smart ones here, the guys with the Bloomberg terminals, the people managing your 401k, they spend all their days staring at just the tip of the iceberg.
The part sticking out of the water.
Right. That represents the ticker price that you see scrolling on CNBC. It's the green and red flashing numbers on your trading app. It's the chart you pull up on your phone.
And that is what we call the paper market.
The paper market. It's visible, it's loud, it's really fast.
And it's where all the headlines are.
Right. But beneath the surface, under that dark, cold waterline, is this massive, hulking, incredibly complex beast that we call the physical market.
And that is where the real world actually lives.
Yes. This is where actual barrels of oil, real bushels of wheat, and literal heavy bars of gold are physically changing hands. Right.
And here is the hook for today, and really the whole reason we're doing this deep dive. We just assume those two things. The price on the screen, the paper, and the price of the physical stuff are the exact same thing.
Which is a huge assumption.
It is. We assume the tip of the iceberg and the bottom of the iceberg are just moving in perfect lockstep. But they aren't always, are they?
No, they aren't. And that right there is where the danger lies. And frankly, it's where the massive opportunity lies, too. Look, those two markets usually do move in sync.
Sure.
They're like two dancers holding hands. They're listening to the same music. But sometimes
the grip flips.
Exactly.
Yeah.
They disconnect. And when the paper market says one thing and the physical market says another, reality eventually wins.
It always does.
Always. But the gap between them, that disconnect, that is exactly where fortunes are made or lost.
So our mission today is to just strip away the noise. We are going to explain the difference between physical and paper commodity markets.
We're going to talk about this mysterious force called basis. Right. Which acts as the glue between them.
Yep.
And we're going to explain why the price you see on your screen isn't always the price of the real asset.
Which is going to change how you look at the news.
Absolutely.
Okay.
So let's unpack this. We have this tale of two markets. Let's define the players first. Who is actually playing in the virtual or the paper market?
Okay, so the paper market or virtual market is defined by financial instruments.
Okay.
When we talk about this world, we are talking about futures, contracts, options, ETFs, swaps, all of that.
And where does this happen?
The venues are these massive centralized exchanges that you've probably heard of. The CME, the Chicago Mercantile Exchange, the NYMEX in New York, the LME, which is the London Metal Exchange.
Right. These are the places with the bells and the screens, the classic Wall Street image.
Exactly. It's highly regulated. It's highly centralized. It's a very clean environment.
And the participants. Because I assume they aren't usually wearing hard hats and steel-toed boots on the floor of the CME.
Far from it. These are the suits, or honestly, more accurately these days, the hoodies and the algorithms.
Right, the tech guys.
Exactly.
Yeah.
We're talking about hedge funds, algorithmic high-frequency traders, institutional investors, pension funds.
And what are they actually trying to do?
Their objective is generally one of two things. First is speculation, just betting on which way the price will go to make a profit.
Buy low, sell high.
Exactly. And the second is hedging, which is protecting themselves against price risk. But here is the absolute key. And if you take nothing else away from this whole section, take this.
Okay.
They have absolutely zero interest in the actual stuff.
The physical commodity.
Right. They do not want the oil.
Right.
They do not want the corn.
I mean, they wouldn't even know what to do with it if they got it.
They'd probably panic. Imagine a hedge fund manager in Manhattan suddenly receiving 10,000 bushels of wheat outside his office.
It'd be a disaster.
Right. They are trading the idea of the commodity, not the commodity itself. And here's a stat that absolutely blows people away when they first hear it.
Let's hear it.
In the oil markets, paper barrels trade at volumes that often exceed 28 times the daily global consumption of actual oil.
Wait, hold on. Let me just process that. Say that again. 28 times.
28 times.
That is insane.
Think about that for a second. For every one single barrel of oil that is actually pumped out of the ground in Texas or Saudi Arabia, refined, and then burned in a car or a factory.
There are 28 barrels worth of paper contracts just flying back and forth on the screens.
Exactly.
That sounds, well, it sounds like a bubble. Or a casino. Is that even healthy for the market?
It sounds wild, right? Yeah, it really sounds like pure gambling. But that liquidity is actually incredibly necessary.
How so?
It allows the guys who actually do have the real oil to hedge their risk. It absorbs the shock.
Oh, okay, I see.
But it does mean the market is driven by leverage and speed, not by logistics. It's a market of clicks, not bricks.
A market of clicks, not bricks. I like that. Okay, so that is the paper world. It's fast, it's loud, it's mostly digital, and it is just massive in volume. Now take us to the physical market, the spot market. What does that actually look like?
So this is the ground truth. This is defined by tangible goods, actual stuff.
The heavy stuff.
Right. The venues here aren't usually a clean electronic exchange with a ticker tape. Transactions happen over the counter, or OTC.
Which means what, practically?
It means they happen at refinery hubs. They happen at pipeline junctions, at physical auctions or agricultural cooperatives. It's dirty, it's industrial.
It literally smells like gasoline and fertilizer.
Exactly. It smells like the real world.
So this is where the producers and the actual end users live.
Spot on. The participants are the miners digging the copper, the farmers growing the soy, the refiners turning crude oil into gasoline.
And the airlines buying jet fuel.
Right. And their objective isn't to bet on a chart to make a quick buck. Their objective is to keep the lights on. It's to keep the trucks moving.
It's survival and operations.
Exactly. And the absolute biggest difference here is the constraint.
Constraint.
Yeah. You cannot day trade a super tanker.
I love that image so much because you can click sell on a futures contract in a millisecond. If the chart looks bad, you are just out. You're in cash.
Right.
But you cannot just teleport a tanker full of crude oil across the Atlantic Ocean just because the MACD chart looks bad.
Precisely. You are bound by physics.
Yeah.
The physical market deals with what we call locational reality.
Locational reality. Let's dig into that.
It deals with storage limits. If the massive oil tanks in Cushing, Oklahoma are full, they are full. You can't just download more space from the cloud.
Right. You can't buy a hard drive for oil.
Exactly. It deals with shipping costs and it deals with quality specs. A paper contract for copper assumes a perfectly standard grade.
But in the real world,
In the physical world, that copper might be in a concentrate form, it might be refined, it might be sitting in a warehouse in Shanghai, or it might be stuck at a port in Chile.
so locational reality is sort of the anchor that the paper market sometimes just conveniently forgets about.
That phrase is doing a lot of heavy lifting, but yes, the paper market assumes a barrel of oil is a barrel of oil no matter where it is.
But the physical market asks, where is it? And is it the right kind?
Exactly. And most importantly, can I get it here by Tuesday?
Right.
Because if the answer to that is no, then the price you see on the screen is completely irrelevant to me. I cannot put a NYMEX futures contract into my gas tank.
So we've got these two parallel universes. One is trading 28 times the volume of the other. One is instant, one is slow and heavy.
Yes.
How do they ever actually agree on a price? I mean, how do we stop the paper price from just floating off into space and becoming totally detached from reality forever?
That brings us to the mechanics of the split and specifically settlement methods.
Okay, the nuts and bolts.
Right. This is how the markets talk to each other. In the paper market, the dominant mode is cash settlement.
Which is basically just settling the bet with money, right?
Yeah, exactly. If you and I trade a cash settled futures contract, when that contract expires, absolutely no oil moves. The losing party just pays the winning party the net cash difference between the spot price and the futures price.
So it's just a wire transfer.
That's the wire transfer. It's convenient, it's clean, and it attracts all those speculators because you don't need a warehouse. You just need a bank account and an internet connection.
But then there's the other way. What you called the nuclear option.
Physical delivery. This is the real anchor.
Okay.
Most major futures contracts, like the WTI crude oil contract or the copper contracts on the LME, they have a provision for physical delivery.
Meaning what?
Meaning, if you hold that contract all the way to expiry when the clock hits zero, you are legally obligated to stand for delivery.
Oh, wow.
You literally have to show up at the pipeline in Cushing, Oklahoma, and take the oil or deliver the oil. Which
is a day trader's absolute worst nightmare. You always hear those urban legends of the guy who fell asleep, forgot to close his position, and got a phone call asking where he wants his 10,000 bushels of corn delivered.
Yeah, those stories are funny, but it rarely actually happens. Maybe 2 to 3% of contracts ever go to delivery.
Because everyone just rolls them over or closes them out before that date?
Exactly. But the threat of delivery, that is what imposes price discipline.
Price discipline.
Right. Because if the paper price gets too far away from the physical reality, a big physical trader like a Trafigura or a Glencore, they will step in.
The big boys.
The heavyweights. They will buy the cheap paper, wait for the delivery, take the physical oil, and then turn around and sell it in the expensive physical market.
Oh, I see.
That arbitrage is what forces the prices to eventually converge.
So the threat of actually having to deal with the real heavy, smelly stuff keeps the paper guys honest.
It's the ultimate tether.
Okay, that makes perfect sense. Now, you mentioned a term earlier that I want to drill down on because it seems to be the secret language of the pros.
Basis.
Yes, basis.
Right.
What exactly is basis?
In its simplest form, basis is the difference between the cash or spot price, the price right here, right now, for the physical good, and the futures price.
Okay, so the math is just spot price minus futures price equals basis.
Exactly. Simple math.
Very simple math. But what does it actually tell us? Why is it the most important number?
Because basis represents the tension between local reality and global expectation.
Unpack that a bit.
Well, the futures price, let's say the NYMEX price for oil that is a global benchmark. It reflects macro headlines, geopolitics, OPEC meetings. It's the big headline mountain.
The thing you see on the news sticker.
Right. But the spot price, that reflects what is actually happening in your own backyard.
Give me a concrete example. What does a weak basis look like in the real world?
A weak basis means the spot price is lower than the futures price. This usually suggests an oversupply locally, or maybe a lack of storage. Imagine you are a producer in the Permian Basin in West Texas.
Okay, I'm a Texas oil guy.
You have oil coming out of the ground, but the pipeline is broken. Or maybe it's just full. You cannot get it to the broader market.
I'm stuck with it.
Right. The NYMEX price on CNBC might be $80. But because you are drowning in oil you can't move, you might have to sell it to a local aggregator for $60 just to get it off your hands.
Wow.
That $20 discount, that is a historically weak basis.
So the screen says everything is totally fine, oil is at 80. But the ground truth says, help, we are drowning in oil and it's trading at 60.
Exactly. And if you're only looking at the screen, you are completely missing the crisis happening on the ground.
And the opposite of that is a strong basis.
Right. That is when spot is higher than futures.
Meaning?
That suggests immediate physical scarcity.
Yeah.
The market is screaming, I don't care what the price is next month. I need this stuff right now.
Give me a scenario for that.
If a refinery explodes or a hurricane hits the coast, you might see the local spot price rip higher, while the futures market barely even moves.
This is so interesting because when we look at, say, the fuel market, traders don't even really quote a flat price, do they? They speak in a sort of code.
They really do. In the real world, physical traders rarely say, I'll sell you this gas for $2.50.
Right.
They quote a differential to the screen. They say, I'm offering 15 cents under NYMEX, or 10 cents over.
The diff.
Yeah, the diff. And this differential is the market for physical traders. They are trading the relationship between the physical reality and the paper benchmark.
So they basically assume the screen price is just a baseline, and the real negotiation, the actual trading, is on the basis.
Exactly.
Let's apply this to a specific case study, because I think the oil and energy sector is the absolute perfect place to see this ecosystem in action.
It really is.
Because it's not just one price, it's an entire chain.
It is a chain, and it moves at very different speeds depending on where you look. At the top, you have the NYMEX, the paper market.
Right.
This reacts to the big stuff.
Yeah.
Geopolitics, currency moves, the weekly inventory reports. It's emotional, it's high speed. Like we said, it's Twitter speed.
Then you go down a level to the spot market.
Yes. The spot market is located at the physical hubs. Think the Gulf Coast, New York Harbor, Los Angeles.
And this reacts to regional news.
Regional supply news. A pipeline outage, a refinery fire. A really great historical example of this disconnect was Hurricane Isaac years ago.
Yeah, walk us through that, because logically, as an investor, a hurricane sounds incredibly bullish for oil prices, right? It disrupts supply.
Right, that is the textbook answer.
Yeah.
And initially, the futures market, the paper market spiked because everyone on Wall Street thought, oh no, supply disruption. Rigs in the Gulf are shutting down.
Right, buy oil.
Exactly. But locally, down on the Gulf Coast spot market, the reaction was totally different depending on exactly where you were standing.
Why is that?
Because the physical ports were closed due to the storm. The ships literally couldn't come in to take the oil out. So some areas were actually flooded with trapped inventory that physically could not leave.
So while the screen in New York said prices going up, the guy with the physical barrel down in Louisiana couldn't even give it away.
Exactly. The base is completely disconnected. If you were trading based on the TV screen, you bought. But if you were trading based on the physical reality in the Gulf, you sold.
That is a fascinating disconnect. It really shows how locational reality just trumps everything else.
Always.
And then further down the chain, you have the rack market and the retail market.
Right. The rack is the wholesale level. That's where the actual tanker trucks fill up to go to the gas stations.
And how fast does that move?
That usually follows the spot market with a slight delay. It often changes prices just once a day, usually at 6 p.m.
And then retail, the price at the pump.
That lags by days. It takes time for that price shock to travel all the way from the NYMEX screen to the plastic sign at your local gas station. We actually call that the rocket and feather effect.
The rocket and feather effect. Explain that.
Prices go up like a rocket when wholesale costs rise, but they float down like a feather when costs drop.
I feel like I experience that literally every time I drive past a gas station.
We all do. It's a universal frustration.
Now, one of the hidden variables you mentioned in our research that I really want to highlight is freight.
Yes.
I think people, especially paper traders, forget that oil has to actually travel. It's not data on a fiber optic cable. It's mass. It's a heavy, dangerous liquid.
Freight is massive. Physical traders live and die by the arb, or arbitrage, but you have to factor in the cost of the boat.
Literal boat.
The literal boat. We look at VLCC rates.
Yep.
Very large crude carriers.
How big are these things?
These are ships that can carry 2 million barrels of oil at a time.
Okay, so how does the cost of the ship actually kill a trade?
Well, imagine you have cheap oil in the US. Let's say it's $70 a barrel. And oil in Europe is expensive, say $75.
Okay, so on paper, you have a $5 profit locked in. The spreadsheet says, buy it here, sell it there, pocket the $5.
Right. It looks like free money.
Exactly.
But what if the cost to rent that VLCC spikes to $6 per barrel because there's a sudden shortage of ships globally?
Then your $5 margin just became a $1 loss.
Exactly. The arb window closes, the oil just stays in the US.
Wow.
The markets disconnect because the bridge between the ship is simply too expensive to use.
That is why physical traders are obsessed with shipping rates.
They track the ships just as closely as they track the commodity itself.
And then there is the quality issue. A paper contract usually specifies a standard barrel, right?
Right. It's usually something like light sweet crude,
Which means what?
West Texas Intermediate, or WTI, which is the benchmark, is a very specific gravity and a specific sulfur content. It's the perfect barrel for the contract.
But nature isn't standardized.
Not at all. The physical market trades hundreds of specific grades. Heavy, sour, acidic, basically sludge.
It's like wine.
It is exactly like wine. And refiners are the sommeliers.
That's a great way to put it.
They pay premiums or discounts based on what their specific equipment can actually process. A highly complex refinery designed for heavy, sour crude might actually pay a huge premium for that junk oil if it's in short supply.
Even if the benchmark light sweet price is falling on the news.
Exactly. So you can see the headline price drop, but the price for this specific gunk that a certain refinery desperately needs is skyrocketing.
Locational reality and quality reality always win in the physical world.
Always.
I want to pivot now to another commodity entirely, one that brings out a lot of passion from investors.
Oh, I know where this is going.
Gold.
Gold.
There is a huge controversy in the space about paper gold. What exactly is the conspiracy there? Or I guess the core concern?
This is what we call the fractional reserve problem. In the gold market, there is significantly more paper gold, meaning futures contracts, unallocated accounts, ETFs, than there is physical bullion backing those specific trades.
It sounds like a bank run just waiting to happen.
That is exactly the fear. Futures contracts allow for massive leverage. A trader can control a huge amount of gold with a very, very small margin payment.
Right.
This creates a situation where the volume of claims on gold vastly dwarfs the actual available physical delivery.
So what happens if everyone stands for delivery at once? If everyone says, give me my gold?
Well, that's the doomsday scenario for the exchanges. In times of extreme financial turmoil, if everyone holding a paper claim said, I want my bar, please, there physically isn't enough bullion in the COMEX vaults to satisfy every paper claim simultaneously.
Really?
Really. The entire system relies on the fact that most people are just speculators who just want the cash difference, not the heavy metal.
So we have a massive split in the investor base here, too.
Definitely. You have the paper investors. They just want exposure to the price action. They want liquidity.
They want to be able to click a button and be out of the trade in a second.
Exactly. So they buy ETFs or futures. But then you have the physical investors. They want true ownership. They want absolute insurance against counterparty risk.
They're the ones actually buying the coins in the bars and, burying them in the garden.
Or storing them in high security vaults in Singapore or Switzerland.
Right.
They pay high premiums, they pay for storage, they pay for insurance. But their argument is very simple. If the system breaks, my gold is physically in my hand. Your gold is just an entry in a database that might get wiped out.
It's the difference between betting on the price of the lifeboat and actually sitting in the lifeboat.
That is a perfect analogy.
Yeah.
And when the ship actually sinks, the price of the lifeboat doesn't matter at all. Only the seat matters.
That's a really stark way to look at it. Okay, let's move to how the pros handle all of this. We talked about Trafigura earlier. These massive trading houses, Glencore, Vital, Trafigura, they are moving billions of dollars of stuff around the globe.
Right.
But they aren't out there gambling on the price of oil going up or down, are they?
No, and this is a key distinction that separates the true professionals from the amateurs. A firm like Trafigura operates on razor-thin margins.
How thin?
We're talking less than 1% sometimes on the raw volume.
Wow.
They absolutely cannot afford flat price risk.
Flat price risk meaning what?
That's the risk that the market price drops 20% while the oil is sitting on their ship for 3 weeks crossing the ocean. If they took that kind of directional risk, they'd be bankrupt in a month.
So they hedge
everything.
They hedge everything.
Walk us through the mechanics of that hedge. How do you buy 1 million barrels of oil and take zero price risk?
It's a balancing act. Let's say a trader buys a cargo of physical crude oil in Nigeria.
They now own the oil. They're what we call long physical. To neutralize the risk of the price dropping, they immediately go to the paper market, usually the futures exchange, and they sell an equivalent amount of futures contracts.
So they are short paper.
Correct. They're long the real thing and short the paper version.
Got it. Now imagine the price of oil absolutely crashes by $10 while the ship is crossing the Atlantic. They just lost $10 million on the physical cargo they are holding. That's a disaster, right?
It sounds like it. But wait, their short futures position just made $10 million because they bet the paper price would go down. The loss on the physical side and the gain on the paper side cancel each other out perfectly. The flat price risk is completely neutralized.
That is brilliant. But if they aren't making money on the price moving up or down, how do they keep the lights on? How do they pay for the fancy offices in Geneva?
They make their money on the basis.
We're back to the basis.
Always back to the basis. They are betting that the relationship between their specific physical cargo and the global benchmark will change in their favor.
How does that work in practice?
Maybe they bought that Nigerian oil at a steep discount because there were no ships available locally, and they're bringing it to a refinery in Rotterdam that is absolutely desperate for that specific grade of oil.
Okay.
So they're exposed to basis risk. That's the risk that the spread widens or narrows against them, but that is a risk they can manage through logistics.
That is such a crucial shift in mindset for anyone listening. Professional commodity traders do not bet on price. They bet on relationships. They bet on logistics. They bet on the inefficiencies between the paper and the physical.
They aren't trying to predict the future. They are arbitraging the present. They are solving a massive logistical puzzle and getting paid a premium for it.
Now, when we look at these markets as outsiders, there are signals that tell us what is really going on beneath the surface. We hear these terms contango and backwardation thrown around.
Right.
They sound like dance moves, but they are actually super important market structures. Let's start with contango. Break that down for us.
Contango is simply when the futures prices are higher than the spot prices.
Okay, so give me some numbers.
So oil today is $70, but oil for delivery in 6 months is trading at $75. The curve slopes upward over time.
What does that actually signal to the market?
It usually implies adequate supply. The market is basically saying, we have plenty of oil right now, we do not need it urgently.
Right.
In fact, the market is essentially paying you to store it. That $5 difference between today and 6 months from now, that covers your carrying charges.
Carrying charges being?
Storage tank fees, insurance, the interest on the capital you tied up. If the market is in a steep contango, professional traders will buy cheap physical oil today, put it in a tank, sell the expensive future contract, and literally just wait.
It's a storage game.
It's purely a storage game.
So it basically encourages hoarding.
It absolutely encourages inventory building, yes.
Okay, now flip it. Backwardation.
Backwardation is the exact opposite. Spot prices are higher than futures prices.
So oil today is 80, but oil in 6 months is 70. The curve slopes downward.
Correct.
That seems counterintuitive to me. Why would it be cheaper in the future? Shouldn't inflation or time value of money make it more expensive?
Normal logic would say yes. But backwardation happens because the market is screaming, we need this stuff and now W. It signals immediate acute shortage. The market is penalizing anyone who stores it. It's essentially saying, do not put that oil in a tank. Bring it to the market immediately. We will pay you a massive premium to deliver it today rather than tomorrow.
Wow.
Backwardation is almost always a very bullish signal for the physical asset because it proves there's a real physical scarcity. It's not just a paper story.
So if I see backwardation on a chart, I know the physical market is genuinely tight?
Exactly. It's the ultimate truth serum. You can hype up a paper market all you want with news and algorithms, but you cannot fake backwardation for very long.
Because someone eventually needs the real barrel. And since these physical trades are private OTC, like you said earlier, how do we even know what the spot price is? I mean, it's not like there's a public ticker for Bob's Barrel of Oil in Cushing.
No, there isn't. And that's where price reporting agencies, or PRAs, come in.
PRAs? Like who?
Companies like Platts and Argus. They are basically the investigative journalists of commodity pricing.
How do they work?
Since there is no central exchange for physical deals, these reporters literally call traders, refiners, and producers every single day.
Just on the phone?
On the phone, on instant messenger. They're asking, what did you buy at today? What did you sell at? What was the volume? They assess all this market chatter, and they publish a daily benchmark.
So the entire physical world relies on these reporters acting as the referees?
It really does. Those assessments they publish become the benchmark for physical contracts globally.
Give me an example.
If you sign a multi-million-dollar deal to buy jet fuel for an airline, you rarely sign for a fixed flat number. You sign a contract that says you will pay the Platts jet fuel assessment plus 2 cents.
Wow. So the PRA is the anchor.
They are the anchor for the physical side, yes.
Let's bring this all back to the listener. If you are looking at your own portfolio, or maybe you just want to actually understand the headlines when you turn on the news, why does all of this deeply technical plumbing matter to you?
It matters because of the tension between transparency and opacity.
Expand on that.
Paper markets offer instant transparency. You can see the exact price on your phone right now. But they are noisy, they are driven by sentiment, they are driven by algorithms, and they are driven by fear.
And the physical markets.
Physical markets are opaque, they are hard to see, hard to track,
Yep.
but they represent the ground truth of actual supply and demand.
So looking at the physical market is kind of like running a lie detector test on the paper market?
That is exactly what it is. And here's a major warning sign that you as an investor can watch for. Divergence.
Divergence between the two.
Right. If you see paper futures rallying, everyone on TV is bullish, the chart looks amazing, CNBC is cheering, but the physical differentials are weakening.
Watch out.
Watch out. If the paper says oil's going to $100, but the physical traders down on the Gulf Coast are discounting their real barrels because they can't find buyers, that rally is likely built entirely on speculation.
It's a paper tiger.
Exactly. And physical reality usually wins in the end.
What about inventory data? We always see these weekly reports on oil inventories.
Inventory is crucial. But again, do not just look at the headline number. You have to look at where the inventory actually is.
Right, a locational reality.
You might have high inventory globally, which looks bearish. But if Cushing, Oklahoma is running empty, the WTI price will still spike, or vice versa. You have to know where this stuff is.
We really have to touch on the financialization debate before we wrap up. There is this huge argument, often very political, that the speculators, the paper guys, are ruining the market for everyone else, that they just distort prices and make gas expensive for regular people. Is that a fair criticism?
It is a very popular political talking point, but the economic reality is much more nuanced.
What's the counterpoint?
The counterpoint is that speculators provide absolutely necessary liquidity. Think about the farmer planting corn or the oil producer drilling a well.
Okay.
They need a hedge. They need to sell their future production today to lock in a price so they can get a bank loan to actually plant the crop or drill the hole.
Right. But who is taking the other side of that trade?
Exactly. If everyone in the market was a producer, everyone would just be selling. You desperately need a buyer.
And the speculator is the buyer?
The speculator takes the risk that the producer wants to get rid of. Without speculators, the market would be incredibly illiquid and, frankly, volatile in a much worse way.
So they serve a purpose.
They do. Long term, the fundamentals, meaning the marginal cost of production that drives the price. Speculators just increase the short-term velocity. They might exaggerate a move for a few days or weeks, but they rarely create a trend that defies physics for long.
So we have covered the players, the mechanics, the massive disconnects, and the signals. Now we arrive at our signature segment of the deep dive, the one question.
My favorite part.
If our listener is looking at a commodity, whether it is oil, copper, wheat, whatever, what is the single question they should ask to cut through all the CNBC noise?
The question is this. Is the forward curve in contango or backwardation, and does the physical basis confirm that story?
Let me repeat that. Is the forward curve in contango or backwardation, and does the physical basis confirm that story? Why is that the ultimate question?
Because this single question tells you if a price move is driven by real-world scarcity or just financial speculation.
Give me the bullish scenario.
If the market is in backwardation, meaning spot is higher than futures, and the basis is strong, meaning local prices are high, that is a true bull market. That is physical shortage. That trend has legs.
But the flip side.
If the price is rising, yet the market is in contango and the basis is weak, that is a fake rally.
It's an illusion.
It is just cheap money and speculation. That house of cards will eventually fall.
That is the difference between a trade that lasts a week and a trend that lasts a year.
Precisely. It filters out the noise.
This has been an absolutely fascinating look under the hood of the global economy. To wrap up this deep dive, let's hit the core takeaways for you to keep in mind.
First takeaway. The price on the screen, the paper market, is a financial derivative. It is a bet. The price at the hub, the physical market, is the logistical reality. They are highly related, but they are not the same thing.
Second takeaway. Basis is the most important number professional traders watch. It is the premium paid for immediate local availability. If you aren't watching the basis, you are only seeing half the picture.
And the third takeaway. Physical delivery is the anchor. It is the nuclear threat that eventually forces the two markets to converge. You can trade paper all day long, but eventually someone has to move the physical barrel.
And I'll leave you with this final, somewhat provocative thought. The next time you see a commodity spike on the news, whether it's gas prices, lumber, gold, whatever it is, ask yourself, is this a paper panic or are the physical barrels actually missing?
Because the answer to that usually determines if the trend will last.
Exactly. Keep your eyes on the basis. Thanks for listening to this deep dive on Talk Tickers. We will see you next time.